Welcome to The Explainer. Okay, let's dive into this. Today, we are unpacking a topic that, it might seem highly abstract and perhaps a little dry on the surface, but it actually dictates the cost of almost everything you buy, borrow, or save. We're going to simplify the role of the Federal Reserve and really understand how their decisions on interest rates ripple out to affect the stock market, your personal loans, the whole shebang. So, how does one room in Washington, D.C. effectively control your wallet? It's a perfectly valid question, right? We hear about the Fed constantly in the financial news, but the line connecting a group of economists sitting around a boardroom table to the interest rate on your credit card or the yield on your savings account, well, it can seem pretty blurry. Today, we're going to clear that up completely and show you exactly how connected you are to that room. Before we get into the mechanics of how it all works, let's define exactly what we're looking at. The Federal Reserve, often just called the Fed, is the central bank of the United States. It was created way back in 1913 in response to financial panics, and its goal is to promote a stable and flexible financial system. Think of it as the orchestrator of the world's largest economy. It's an independent institution tasked with keeping the economic engine running smoothly without overheating or stalling out.
All right, moving right along to our first key concept, the master rate lever.
This right here is the inciting incident of our economic domino effect. The primary tool the Fed uses to influence the entire country's economy is the federal funds rate. By definition, this is the overnight interest rate at which banks lend their reserve balances to each other. Now, I know, it sounds highly technical and completely detached from your daily life, doesn't it? But actually, it's the baseline lever for all other borrowing in the economy. This single benchmark rate is literally the very first domino to fall in a massive chain reaction that eventually reaches your bank account.
Let's break down exactly how a decision made in Washington translates to the interest rate at your local bank branch. Step 1. The Fed adjusts the federal funds rate. Step 2. Because of that adjustment, commercial banks now have to pay more or less to borrow money to meet their own reserve requirements. And step 3, banks aren't just going to absorb those adjusted costs, no way. They pass them straight down to you, the consumer, on everyday loans. It's a direct, logical pipeline from their boardroom to your borrowing costs.
Think of the economy like a massive car, and this lever as the pedals. Rate hikes act as the brakes. When inflation is high and prices are out of control, meaning there's basically too much money chasing too few goods, the Fed makes borrowing expensive. This slows down consumer spending and business expansion, essentially cooling the economy. Rate cuts, on the other hand, well, they're the accelerator. When economic growth is sluggish and unemployment is rising, the Fed makes borrowing cheap. Why? To incentivize businesses to hire and consumers to spend, boosting job growth. Now, what's really interesting about this slide is the direct impact on your wallet. Seeing how those macro-level decisions translate into actual dollars and cents is pretty eye-opening. Looking at this data from Bankrate, it's incredibly clear how much more expensive it became to finance big-ticket items between July 2021, when rates were near zero during the pandemic, and January 2025, after a series of rate hikes. A $30,000 home equity line of credit jumped from 4.24% to 7.44%. Average credit card rates spiked by nearly 3.5 percentage points, getting awfully close to 20%. And a 5-year new car loan went from just over 4% to over 7%. That is a massive increase in the cost of borrowing for the exact same products, directly caused by the Fed putting the brakes on the economy. To put it in perspective, financing a $500,000 mortgage went from costing about $2,000 a month to over $3,000 a month just in principal and interest. But hey, it isn't all bad news. There is a flip side to this domino effect that actually benefits your wallet. Savings yields move in lockstep with the Fed. Higher borrowing rates also mean higher returns on your savings accounts and certificates of deposit. For years, keeping cash in the bank earns you essentially zero. But when the Fed hikes rates, low-risk investments like CDs suddenly become worth looking at again, allowing savers to actually earn a decent yield on their cash without having to take on stock market risk. Next up, let's explore the ripples in the market. You see, the Fed's decisions don't just stop at consumer loans. They wash over the entire financial system and heavily influence investor portfolios. Let's contrast the environments of expensive money versus cheap money. When rates rise and money becomes expensive, investors often reshuffle their portfolios. They flee the stock market for the safety of high-yielding CDs and bonds. This drains excess liquidity from the stock market and can spark fears of an economic recession, causing markets to choke, kind of like what we saw back in 2022. But when money is cheap because of rate cuts, it floods liquidity back into the system. It incentivizes risk-taking because investors simply can't get good returns in safe savings, so they pour money into equities, which boosts corporate earnings and drives up stock valuations. Because of this, it's absolutely essential to know where capital flows when the Fed decides to cut rates. According to analysis from Van Eck, there are specific asset classes that typically benefit when the accelerator is pressed. We often see renewed inflows into cyclically sensitive areas, like growth and technology stocks, as well as consumer discretionary stocks. But fixed income also sees major shifts. Emerging markets bonds, represented by funds like EMBX, often outperform as investors search for higher yields globally, benefiting from a weaker US dollar. Similarly, municipal bonds, like MLN, can perform strongly as yields decline and the demand for income really starts to grow. And this brilliantly illustrates our final core concept: the ultimate balancing act. The Fed must walk an incredibly difficult tightrope to keep the global economy from falling apart, and they're guided by what is known as their dual mandate. They must balance maximum employment, which means keeping the economy growing fast enough so that people have jobs and businesses are thriving, against stable prices, preventing the villain of inflation from destroying the purchasing power of your hard-earned money. The inherent tension here is immense. It's a real tug of war. The tools used to achieve one goal often actively sabotage the other. If you cut rates to boost jobs, you risk sparking runaway inflation. If you hike rates to crush inflation, you risk causing widespread layoffs and a recession. Just to show you how extreme this balancing act can get, take a look at this staggering number: 20%. Back in the late 1970s and early 1980s, the US was suffering from stagflation, a really toxic combination of high inflation and slow growth. To crush that inflation, then Fed Chair Paul Volcker hiked the federal funds rate to a massive 20% in 1981. It was incredibly painful, it made borrowing nearly impossible, and it caused a severe recession. But it was the extreme medicine required to finally stabilize prices and reset the economy for the long term. This extreme historical example highlights a crucial quote from Central Trust regarding why the Fed's structure actually matters so much. This separation from political cycles allows the Fed to make unpopular but necessary choices to secure long-term economic health. Politicians naturally demand lower rates to boost the economy in the short term, especially when elections are approaching. However, the Fed's political independence is absolutely crucial. It allows them to impartially make those tough, sometimes painful stabilization decisions without having to worry about winning votes or appeasing political cycles. As we wrap up this explainer, I want to leave you with one final, very important question to consider. How are you positioning your finances for the Fed's next move? Whether they're gearing up to tap the brakes or step on the accelerator, those decisions will undeniably ripple through your loans, your savings accounts, and your investment portfolios. Understanding this mechanism gives you the power to anticipate those changes and protect your wallet. Thanks for joining me on this explainer, and keep learning.